In the past year, many of my clients have been voicing concern over the shift in the real estate market and how that can affect them and their home purchase and home selling aspirations. Fannie Mae predicts that home prices will fall nationally 1.5% next year. Morgan Stanley predicts a 4% drop in home prices. However, let's take a look at the available data and see what exactly is happening in the market and why.
Now, we looked at the data. And what we found surprised us.
If we look at these charts for the Chicagoland area that I serve, which covers a northwestern coverage slice from the Chicago Loop and stretching out to the western, northwestern, and northern suburbs, we can take a look at the month-to-month median sale price. And here you will notice that home prices peaked in June of 2020 at $340,000 and then went down to $300,000 in October of 2022. This is a drop of about 11%.
Oh my God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm!
However, before you panic, understand that this is a natural ebb and flow in the market. If we look at what happened the year before in the hottest real estate market in recent history, we will see a similar trend where in June of 2021, there was a median sale price of homes of $319,000. And in October of 2021, the median sale price of homes landed at about $290,000. That too was a drop of about 9%. The difference of 2% between these 2 years can be reasonably chalked up to the rise in interest rates, forcing a lot of buyers out of the market and therefore lowering the demand for homes. Simply, there's less people buying homes. To give some perspective on what a 2% decrease in median home price is like, the 2008 crisis brought national drops in homes at a range of 30 to 33%, depending on the market. This is not the same. And things have also changed to avoid creating circumstances that caused the 2008 crisis. I will be covering that in an in-depth video discussing market crashes generally, and why I and many of my clients feel more comfortable investing large sums in real estate than in any other market, and why banks frankly feel comfortable funding those efforts. I'll also go over the regulatory changes and give you my lawyer's perspective on what exactly had changed on the upper level in the federal government and how that translated to changes in practices at the closing table. But in this video, I want to talk about how this 2% decrease in median home price compared to last year's hottest market in recent history should not affect your goals in trading up your home. Waiting is going to be the more costly choice because you will fall victim to rising interest rates. This video is going to help you understand the market and when to make a move, which is now rather than later. So how do I know when to sell? And how do I know that this 2% drop is not a taste of a crash to come? In my opinion, and the opinion of many experts that analyze this market, this is not a sign of things to come. The market reacts to supply and demand, and lately supply has been drastically down to offset any changes in demand. We need to understand how we got to this point, where median home prices have rapidly grown in the past 3 years. The answer lies in the pandemic and how it shifted the attitude of many Americans to a more fiscally conservative attitude. I say this all the time and I will say it again. The home is usually a family's greatest asset. And for that reason, after the pandemic hit, people held tightly to their homes. However, in the same vein, due to the pandemic, many people started to feel stir-crazy in quarantine and started shopping around for homes. I also noticed a rise in divorce filings during this time because, again, people were stuck in the same place, either stuck in the same place or with the same person and wanted a change of atmosphere, either by finding a new home or getting on to a new life. That combined with stimulus checks, student loan payment freezes, many saw it as a good opportunity to save up for their 3.5 to 5% down payment requirement for a home loan and start shopping. The economy began reacting to the pandemic after the World Health Organization announced the pandemic in January of 2020. In March of 2020, lockdowns began signaling the start of a massive economic downturn based on this public health response. Since that time, there has been a steady rise in the median sale price of homes, starting most drastically in June of 2020. This is the data for the market that I live in and work in, but since Chicago is a major metro area, it is not an uncommon trend. You've likely heard similar stories about rocketing home prices in other areas.
Over the course of 2020, COVID-19 has brought the world economy to its knees, but the real estate market has been booming in most middle and high-income countries.
But the headline here is that prices are still on fire. The median price of an existing home sold in March was $375,300, an increase of 15% from March of last year, and the highest price the realtors have ever recorded, at least since they started in 1968.
In June 2020, the median home sale price in the Chicagoland area that I serve was about $250,000. By June 2021, the following year, the median price jumped to $289,000. And by June of 2020, this year, the price had jumped to $305,000. And as of October of 2022, that price is sitting at $310,000. This chart is averaging the data over 12 months, so you'll see a smooth rise and then what seems to be a plateauing most recently in October of this year. The November numbers will be out in the beginning of December, and I'll give you guys a December market update so we can see exactly what this plateau is becoming, whether it's dipping down now or it is still steadily rising. In the inverse, let's take a look at the amount of homes for sale, where that had dropped off drastically starting in June of 2020 after the quarantine was announced. In June of 2020, we had about 35,000 homes for sale. The following year, in June of 2021, we had about 24,000 homes for sale, almost a 33% decrease. And then in June of 2022, this drop slowed, with us having about 19,000 homes for sale. What this ultimately means is that we can reasonably determine that we will not see a market crash like we've seen in 2008. This is simply because there are too little houses on the market to cause such a drastic drop in price. Demand did go down because of the rising rates of mortgages, pushing a lot of formally qualified buyers out of the market. In response, some sellers have dropped their prices, but not significantly. The most significant price drops that you may have heard, and in my experiences, have been homes that have been listed since the summer and have stagnated sitting there for months at a time, where in most cases homes have been selling in a week's time in my experience, and on average in about a month or 2 weeks' time. This means that those homes that have accepted 10% price drops were massively overpriced in the first place, and so now the sellers, as they feel the pressure of the holidays, are looking to sell by accepting such a price drop, but it is not indicative of the market as a whole. Additionally, with respect to supply, there's nothing out there that's going to show a drastic change in the amount of homes available. In 2008, that was different. There's a substantial flooding of the market with foreclosed homes after many of those who qualified for a mortgage in the first place defaulted on their mortgage. This was due to loaning practices that didn't vet people properly and caused the subprime loan crisis, which is discussed in movies like The Big Short. Those subprime loans were bundled and traded on the secondary mortgage market and ultimately crashed out once those people stopped paying their mortgage, and banks desperately tried to recoup what they had lended and foreclosure sales to cover the costs of the mortgages given. These days, there are no such mortgages available. As banks can no longer offer no money down mortgages, they must better vet their buyers and otherwise provide a lot more disclosures that I go over with my clients at the closing table. Furthermore, the construction industry is in no position to pump out enough homes to meet the market demand for these homes anytime soon. The pandemic significantly impacted supply lines for the industry and caused intense logistic issues that are still being resolved. These were the same problems that caused the shortage of toilet paper during the pandemic. Furthermore, many workers in the construction industry decided to take the pandemic as an opportunity to retire. So now the construction industry is lacking both materials to build and the labor to build it, causing a slow in the amount of homes being built compared to prior years. We can see that in this chart showing the amount of new construction homes for sale is drastically low, bottoming out at 1,750 homes in October of 2022 compared to 3,200 new construction homes available for sale in January of 2020. Also, please note this chart, which shows the amount of mortgage applications for the same periods compared to a rise in interest rates. Notice how the amount of buyers in the summer also peaked and then dropped off. Furthermore, notice the steady decline of mortgage applications for this entire year, which shows that there will be even less buyers in the market in the coming months. This is likely the most influential variable in the coming 2023 market. Less buyers equates to less demand. What may bring up the amount of buyers in the market is a drop in interest rates, but that is unlikely. And we will know for sure once the Federal Reserve Bank has its FOMC meeting on December 14th. The Federal Reserve and its officials have stated that they may raise interest rates another 0.75%. Other officials are saying that they're only going to raise the interest rates by 0.5%. Either way, it is unhelpful as far as pushing more buyers or motivating more buyers to get into the market. To give you some perspective on what difference in interest rates may mean for buyers, and especially for you as a seller who will be a buyer, simultaneously selling your home and looking to purchase your next one in a trade up, something that will give you some perspective is taking a look at how mortgage rates increased this year, with the average being 5% in the summer and now hovering around 7%. If, for your example, your budget for a home is $350,000, there is a major difference between interest payments at 7 and 5%, which are accounted for in your monthly payment, and over the 30-year period you will prospectively have your loan. We'll assume a 3.5% down payment in both scenarios, and we will not be accounting for private mortgage insurance, taxes, or anything of the like. This is strictly analysis of how interest can accrue over a 30-year period for a mortgage at two different interest rates. 5% will have a monthly payment of $1,813.12. Over 30 years, you'll end up paying a total of $314,971.41 in interest alone. At 7% rate, you're paying $2,247.06, and over 30 years, you'll end up paying a total of $471,191.30. This is the difference between buyers who purchased in the summer, despite the craziness and despite the hardcore competition and multiple offer situations that they were in, and weathered the storm and made the purchase anyway, and those who decided to wait and lost money in the fall. The difference exactly in this particular scenario for a $350,000 home is, over 30 years, $156,000, $219.89 over 30 years, with an additional $400 monthly paid to their monthly payment for their mortgage. You are losing lots of money by waiting. Any kind of dip in the market, a 2% dip is nothing compared to this. For $350,000, a 2% dip is $7,000. If we're paying an additional $400 a month, you'll clear $7,000 in about 2 years of ownership. And then over 30 years, we're talking about a difference of $150,000, a bit more than that. You're not saving money by waiting. You're not saving money on banking on home prices dropping. And you're not saving money by not taking advantage of this market, which is still very favorable to sellers because of the short supply of homes. There's little competition out there, and there's still, in many ways, you can name your price. The people who are losing here is not understood in the sense of buyers versus sellers. It has to be understood in the sense of consumers versus banks. The banks are losing here. They have to reconcile with rising interest rates and lack of interest from the public in lending money from them. And so by offering lower interest rates, they're getting less money out of these deals. Now, interest rates will continue to go up, and they must go up because the federal government is interested in combating inflation. And the classic way to do that is to raise interest rates. So, if you want to get the best deal possible as a seller right now, the best thing to do is to put your home up for sale now, make a good plan, and I'll discuss in another video how to make a proper marketing plan, and I'll link a link in this description of a free marketing toolkit that you can use to start planning out your marketing for the sale of your home. But ultimately, understand that if you sell now, take advantage of this seller positive market, and then take advantage of interest rates before they rise any higher, you will be saving hundreds of thousands of dollars in some cases over a 30-year period, or thousands of dollars every single year and hundreds of dollars every single month. What you need to do is stay focused on your goals. Take advantage of the seller's market. Take advantage of rates before they get any higher. And never forget that even though higher interest rates may be scary, there's always the possibility to refinance down the line and save yourself some money, which is the smart thing to do. This is the game that you play. This is the percentages and money game that you play when you're trying to make money in the real estate market. You have to leverage interest rates. You have to leverage the market, and having a professional on your side is going to help you. So I encourage you to reach out for a free market analysis of your home and marketing toolkit that will help you get the most value out of your home and weather the storm no matter what may be happening in the market. I appreciate you guys sticking around to listen to this, and I hope this was all helpful to you. My name is Casper. I'm a licensed attorney and real estate broker here in Illinois. If you guys have any questions for me, I encourage you to reach out for a one-on-one consultation, and I'd love to answer any questions and figure out the best plan that's going to serve you best no matter what your situation is, no matter what the market and any of the news pundits might say. Thanks so much. Have a great day, and thank you.